Hey option traders, today we're talking about what is a short straddle. Here's what you need to know. First, a short straddle consists of one short call and one short put. As we know, there are only two types of options, calls and puts, and there are only two things we can do with these options, buy them or sell them. For the short straddle, both your short call and your short put will have the same underlying stock, the same strike price, and the same expiration date. So, for example, to set up a short straddle in XYZ stock, you'll need to sell one XYZ call with a 100 strike price that expires in June. You'd then also need to sell one XYZ put with a 100 strike that expires in June. This will create a short straddle. With a short straddle, you, the seller, will receive a premium for the trade that is paid by the buyer. The trade profits if the underlying stock trades in a narrow range between the break-even points of this trade. But the profit potential is limited to the total premium received at the start of the trade. The tricky part about this trade is that the potential losses could be unlimited if the stock price rises. If the stock price falls, then losses could be substantial, although not unlimited. The max profit is achieved in this stock only if the short straddle is held to expiration and the stock price closes exactly at the strike price. Here, both options would expire worthless and you keep the full premium. The max loss is potentially unlimited because the stock price could theoretically rise indefinitely. To find the break-even points on your short straddle, simply take the strike price of the options and then subtract the total premium per contract received. That'll give you your first break-even point. To find your second break-even point, simply add the total premium per contract to the strike. So to summarize, this trade generates a large amount of premium for the option seller, but it does come with risks. A short straddle is an unprotected trade, sometimes referred to as a naked trade. Naked options can be risky as they expose the trader to potentially unlimited losses if the stock makes a big move. However, if the trader is right and the stock trades sideways, large gains are also possible. For more on this and other option strategies, be sure to check out the new Options Trader app from IBD for digestible options education and tons of great trade ideas. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment.